So what if I told you that a company reporting like a $10 million profit isn't actually stating an objective mathematical fact?
Right. I mean, people really struggle with that idea. It sounds crazy, but that profit number is actually just expressing a highly educated opinion.
Exactly. Because, usually when we talk about the language of business, there is this expectation of just absolute rigid precision, like a
Oh,
machine.
well, totally. The human brain desperately wants to view those spreadsheets as impartial mirrors, like they're reflecting the exact undeniable state of a company.
Yeah, you look at a company's financial report, you see the ledgers, the perfect little rows of math, and you just assume you're looking at the unvarnished truth.
Right. Because it feels safe to treat accounting as this, like, binary system of pure mathematics.
But the moment you peek behind the curtain of modern financial reporting, that perfect mirror just shatters. You realize you are looking at a landscape that is, well, incredibly dynamic, surprisingly human, and entirely dependent on who is telling the story.
It really is all about the narrative.
So welcome to today's deep dive. Our mission today is to decode accounting, which is literally the language that runs the global economy.
It's the foundation of everything.
And for you listening, we're pulling our insights today from a really comprehensive university-level management textbook. We're looking specifically at units from Accounting for Managers to really get into the mechanics of how economic events are translated into these narratives.
Narratives that, dictate everything from your next raise at work to national tax policy.
Right. So to truly grasp how this language operates, we first have to separate the mechanical capture of data from the actual art of building that financial narrative.
Yes, and that is a huge distinction. People tend to conflate the two.
Right.
They assume the person logging the receipts is, the exact same person determining the corporate strategy.
Okay, let's unpack this because there is a massive conceptual divide between bookkeeping and accounting.
Huge divide, yeah. Bookkeeping is really the primary stage. It's routine, it's repetitive.
To conceptualize the difference, I always look at bookkeeping like a scribe furiously writing down every single word spoken in a highly contentious courtroom trial.
Oh, that's a great way to put it.
Right, like they're capturing every cough, every objection, every mundane procedural detail, but they aren't passing judgment on what it means.
Exactly. The bookkeeper is just identifying, measuring, recording, and classifying data. Usually this is done by junior staff.
But accounting is like the savvy journalist taking all that raw data, those chaotic transcripts, and editing them into a compelling front-page story.
Right, because accounting takes over exactly where that mechanical process ends. It's an advanced analytical stage performed by senior staff. They have to summarize, interpret, and communicate a coherent reality.
So what does that actual cycle look like from the scribe to the journalist?
Well, the core accounting cycle starts with the journal, which is just recording things in chronological order. Then it moves to the ledger, where you classify those transactions.
Okay, journal then ledger.
Right. And then you do a trial balance to check the math. And finally, you build the profit and loss account and the balance sheet.
Got it. And the whole thing is built on that fundamental equation, right? Assets equal liabilities plus owner's equity.
Yes. Your assets, which are tangible and intangible things you own, will always equal your obligations, meaning your liabilities, plus the owner's equity.
Okay, but I'm struggling a bit with the leap from that raw balanced data to the final narrative. If the foundational math is identical, could two different accountants look at the exact same ledger of raw transactions and legally generate two completely different profit numbers?
Oh, they absolutely could. Happens all the time.
Wait, really? How?
The mechanism that allows for that is the central nucleus of accounting theory. It's called the matching principle.
The matching principle, okay.
Yeah. The rule dictates that a business must periodically match its efforts with its revenues, which are its accomplishments.
Right, in the same time period.
Exactly. But deciding when an effort translates into an accomplishment is, well, it's highly subjective.
Give me a concrete example of how that plays out in real life.
Let's say a pharmaceutical company spends $2 billion this year researching a new drug.
Okay, $2 billion. Huge amount of money.
Right. The bookkeeper, the scribe, simply logs a $2 billion cash outflow. Done. But the accountant, the journalist, has to make a choice.
What kind of choice?
Do we record that entire $2 billion as an expense this year, which would completely wipe out our annual profit? Or Do we argue that this research will generate revenue for the next 20 years?
Ah, I see where this is going.
Right. If it generates revenue for 20 years, they can spread that $2 billion cost out over 2 decades.
Oh, wow. So if they expense it all now, they look like they are just bleeding money, which might panic the market and tank their stock.
Exactly.
But if they spread it out, they report a massive profit this year, even though that $2 billion in cash is already gone from the bank.
And here is the kicker. Both approaches use the exact same underlying bookkeeping data. The accountant is making a strategic, analytical judgment about how to present the economic reality of that research.
That is wild, because there is so much room for interpretation in crafting this story. I assume the system needs some kind of strict internal mechanics to prevent total fiction from taking over.
Definitely. It needs internal laws, which brings us to the engine of the whole operation, the double entry system.
Right. We all kind of know the basics of the dual aspect principle, right? Every transaction has two sides, a debit and a credit.
Yes, every debit requires an equal and opposite credit. It's a very elegant scientific method.
Because it keeps that fundamental accounting equation we mentioned earlier perfectly balanced.
Exactly. It creates a self-balancing loop. By forcing every single economic event to be viewed from two intersecting angles, like where did the value come from and where did it go, it creates this internal arithmetic checkpoint.
Which makes it vastly superior to just keeping a single entry list of expenses.
Vastly.
Mm-hmm.
Because you can run a trial balance at any moment.
Yeah.
And if the two sides don't match to the penny, you immediately know an error occurred in the data capture phase.
Okay, but let me challenge the ultimate value of that perfect math for a second.
Go for it.
If every debit perfectly matches a credit and the trial balance is flawless, does that actually prove the business is doing well?
Well, no, not necessarily.
Right. Suppose a CEO decides to buy a fleet of completely obsolete, gas-guzzling delivery trucks for $50 million right before a massive fuel crisis.
Oh, terrible idea.
Horrible business decision. But the bookkeeper records a $50 million increase to assets and a $50 million decrease to cash. The math is pristine. The equation balances perfectly.
Right, the system did its job.
But it was a fatal strategic blunder that might bankrupt the company. The perfect math completely hides the terrible reality.
What's fascinating here is that the modern accounting profession openly acknowledges this blind spot.
They do.
Yeah. The textbook actually breaks down the role of the accountant as a service function with an advisory role. They play two parts, a watchdog and a helper.
A watchdog and a helper. Okay, break that down.
Historically, they were just the watchdog, doing the scorekeeping for top management, proving the math of what already happened.
Making sure the $50 million was actually spent on the trucks and not stolen.
Exactly.
Oh.
But today, data evaluation is considered the most important activity in modern accounting, far surpassing just the record-keeping aspect. They have to act as a helper for middle management, directing attention and solving problems.
So how does the accountant act as a helper in my scenario with the obsolete trucks?
A modern accountant engaged in budgetary control wouldn't just wait to balance the books after the trucks were bought. They would evaluate the proposed capital expenditure beforehand.
Oh, they model it out first.
Right. They analyze alternative courses of action. They would run projections on fuel costs, analyze the opportunity cost of tying up $50 million in cash, and present management with the financial implications of, say, leasing electric vehicles instead.
So they shift the focus from just recording the past to actively engineering the future.
Exactly.
Okay, so the accountant evaluates the data, acts as a helper, and ultimately crafts the final financial statements. But once that narrative is published, the profit and loss account, the balance sheet, the story seems to mutate entirely depending on who is actually holding the document.
Well, yeah. Fundamentally, accounting is an information system. You have inputs, which are the raw data, processes, which are the men and equipment, and outputs, which are the reports.
And like any system, its ultimate utility is judged by how well it serves its end users.
Right. But the friction arises because those outputs must serve highly varied groups of people whose goals are, well, they're in direct, aggressive conflict with one another.
So what does this all mean? I look at a single financial report as essentially a financial Rorschach test.
A Rorschach test. I like that.
Yeah, you hand the exact same document to 5 different stakeholders, and they see 5 completely different realities based on their own personal incentives.
It's true. Consider a scenario where a manufacturing firm releases a report showing a sudden, unexpected $50 million cash surplus.
Okay, $50 million in extra cash.
The shareholders, the investors who own the equity, they look at that surplus and see profitability and growth prospects. Their priority is maximizing return on investment.
So they demand that cash be distributed as dividends or, used for a stock buyback to inflate the share price.
Exactly. But the creditors, like the banks holding the company's loans, they're looking at that exact same $50 million with a completely different motive.
Right. They don't care about the stock price at all.
Not even a little. They care about liquidity and solvency. Can the company pay its short and long-term debts? They want that cash kept safely in the bank as a buffer to guarantee their loans get repaid.
Or they want it used to pay down debt early.
Right. Then you introduce the employees into the ecosystem. The textbook notes a rising trend in what they call industrial democracy.
Industrial democracy. What does that mean in this context?
It's where workers demand a voice in management and full disclosure of financial facts. So the workforce looks at that $50 million surplus and they see leverage.
Ah, they see the capital required for fair wage negotiations, profit-sharing bonuses, and better working conditions.
Exactly.
If you are listening to this right now, think about which hat you wear. When you look at your own company's quarterly earnings, are you looking at it as an employee hoping for a year-end bonus? Or are you like a minor shareholder hoping your retirement stock pops?
Because your perspective completely alters how you define good news.
Completely. And we haven't even mentioned the government yet.
Oh, the government is a massive user of this information system. In a mixed economy, they rely on aggregate corporate financial data for macroeconomic planning.
Right. They use it to check national growth and dictate policy.
And most directly, for tax collection. To the government, that $50 million surplus is simply a taxable target.
And finally, you have the general public and consumers, right? They might look at that exact same surplus and ask if the company is fulfilling its social responsibility.
Exactly. Like, are they using those profits to lower consumer prices or reduce their carbon footprint?
It's crazy. You have one set of documents trying to serve the worker who wants a raise, the shareholder who wants a payout, the bank that wants security, the government that wants taxes, and the public that wants ethical behavior.
It is an immense burden for one single information system to bear. And because so many competing factions rely heavily on these reports to make massive, life-altering economic decisions, the system is just under constant pressure.
Which means we have to look critically at the inherent limitations of the architecture. Where does the language of accounting actually fail us?
Well, the limitations are pretty severe. It is not fully precise, and it heavily relies on personal bias.
Here's where it gets really interesting, I think. Because one of the most glaring blind spots is that the system entirely ignores qualitative information.
It does, because the machinery of accounting is strictly designed to process monetary transactions.
Right, so it is completely blind to anything that doesn't have a clean dollar sign attached to it.
The implications of that are actually profound. I mean, a company could possess an incredibly toxic corporate culture, an exhausted and demoralized workforce, and a CEO who is entirely out of touch with the market.
But none of those catastrophic qualitative realities will show up on a balance sheet, not until the company actually starts hemorrhaging cash.
Exactly. And conversely, a brilliant, highly motivated R&D team is technically invisible to the accounting system until they finally patent and sell a product.
It's like trying to judge the quality of a restaurant by only looking at the cost of its ingredients, without ever tasting the food or meeting the chef.
That's a perfect analogy. And another massive structural flaw is the reliance on historic values.
Right, historic cost accounting. Explain how that works.
The standard practice is to record assets at their original purchase cost, minus depreciation. It completely ignores current market realities or, the corrosive effects of inflation.
So to put that into a mechanical context, imagine trying to assess the true power of a modern tech giant by calculating the original purchase price of its office servers while assigning literally $0 to its user base or its proprietary algorithms.
Right, it makes no sense today. Or consider a company that bought prime real estate in Manhattan in, say, 1970 for $2 million.
Oh, wow. Okay.
50 years later, that land might be worth $200 million. But on the official balance sheet, it just sits there, stubbornly valued at a depreciated fraction of that original $2 million.
Which is insane. We're essentially demanding that investors and employees make massive decisions about the future based on a financial map drawn decades in the past.
Yeah.
It's like trying to navigate a modern city using a map from the 1800s. Like, you know exactly where the old dirt roads used to be, but it tells you absolutely nothing about the current highway system.
If we connect this to the bigger picture, you are highlighting exactly why the global accounting profession has had to engineer strict qualitative characteristics to safeguard financial reporting.
To combat these deep structural flaws, right?
Yeah.
The subjective bias and the historic distortion.
Yes. The textbook emphasizes that to remain useful to society, the data must meet rigorous standards.
These characteristics are supposed to act as guardrails. We have reliability, meaning the information must be free from material error.
Right. And relevance, it actually has to apply to the decision maker's needs.
Understandability, of course. But the one that seems most critical to me is comparability.
Comparability is the ultimate stress test. Users must be able to compare a firm's performance across different time periods and against competing companies in the exact same industry.
Because if a company can arbitrarily change its accounting methods year over year, it completely destroys comparability. Like, if I am the CEO and I see that we are going to report a massive loss this year, a lack of comparability would allow me to just suddenly change how we calculate the depreciation of our factories to magically, create $10 million in profit on paper.
And that deliberate manipulation is known in the field as window dressing.
Window dressing.
Yeah, it is the intentional exploitation of accounting's subjective nature to present a financial position that is artificially favorable.
Just making things look prettier than they are.
Right. Like, a company might delay paying its suppliers until the first day of the new year, so its current cash balances look exceptionally strong on December 31st.
Wow. So they aren't technically breaking the math of the double entry system, right? The debits still equal credits.
Sure.
But they are absolutely violating the spirit of reliability and relevance.
They are, which perfectly transitions us into how this language is being forced to evolve.
Yeah.
Because the old watchdog role isn't equipped to handle a CEO who knows how to weaponize the accounting rules against the system itself.
Right. And this has given rise to specialized fields, which is covered in Block 5 of the text, right? Like forensic accounting.
Yes. As financial architecture has become more complex, so have the scams and the frauds. Forensic accounting isn't just balancing the ledger. It is deploying accounting techniques as active investigative detective work.
So they are literally the financial crime scene investigators.
Yeah, basically, yeah. They are specifically trained to look for the anomalies, the window dressing, and the hidden liabilities. They are gathering financial evidence that meets the rigorous standards required to be sustained in a court of law.
That's fascinating. But beyond just catching fraud, the system is also trying to fix its inability to measure qualitative value, right? Which brings us to another emerging concept, human resource accounting.
This is a really exciting area because it raises an important question about how we fundamentally define an asset.
Okay, how so?
Historically, the millions of dollars a corporation spends on recruiting, training, and developing its employees have been treated purely as a revenue expense. In the eyes of traditional accounting, training your workforce is financially treated the exact same way as paying the electric bill. It is just a sunk cost that lowers your profit for the year.
It's basically treated like a penalty. Like, oh no, we had to spend money training our people.
Precisely. But human resource accounting proposes a radical paradigm shift. It argues that a highly trained, specialized workforce is actually a vital economic resource that will generate future revenue.
Right. They're the ones actually building the products.
So therefore, the cost of developing human resources should be capitalized. It should appear as a distinct asset on the corporate balance sheet.
Wow. Think about how drastically that changes the narrative for a company.
It changes everything.
Instead of a company apologizing to its shareholders saying, oh, sorry, we reported a lower profit this year because we had to spend $50 million training our staff, they can proudly declare, we invested $50 million this year to build a massive revenue-generating asset called our workforce.
Exactly. Now, while it hasn't completely rewritten the mainstream balance sheet yet, progressive companies are already beginning to value their human capital and disclose it in supplementary statements.
It is a direct, mechanical attempt to fix the system's historic flaw of ignoring human qualitative information.
It really is. It proves the system can evolve.
You know, it is incredible to see how a discipline most people associate with, like dusty ledgers and boring spreadsheets, is actually this living, breathing ecosystem.
It's constantly shifting.
Right. We started this deep dive exploring the fundamental shift from the scribe-like mechanical capture of bookkeeping into the highly interpretive, journalist-like world of accounting.
And then we examined the elegant self-balancing loop of the double entry system while also acknowledging that, flawless arithmetic can still hide catastrophic strategic failures.
Which requires the modern accountant to step out of that pure watchdog role and become a forward-looking advisor, a helper.
Right. We also saw how a single financial report fractures into a Rorschach test, sparking these fierce tug-of-wars between shareholders seeking dividends, creditors demanding security, employees fighting for leverage, and governments collecting taxes.
And we looked at the structural blind spots, the danger of historic cost accounting acting like an outdated map, and the vulnerability of window dressing.
Ultimately, the evolution toward forensic accounting and human resource accounting proves that the language of business is constantly updating its vocabulary. It's trying to better capture the true complex nature of human enterprise.
It's far more than just a calculator's output. It is the story of human endeavor translated into a common metric.
Very well said.
Which leaves you with one final thought to mull over. We've seen how accounting evolved from wealthy individuals just hiring stewards to protect their physical wealth to today's proposals for human resource accounting, where human skills are explicitly treated as corporate capital.
It's a huge leap.
So, think about this. If the future of the economy involves literally placing a precise financial asset value on human development on a corporate balance sheet, how might your own curiosity, your continuous learning, and your adaptability be quantified, depreciated, or traded by the companies of tomorrow? Just how much of an asset are you?
The mechanics of how we measure that worth will definitely define the next era of business.
Thank you for joining us on this deep dive. Remember, the numbers are never just numbers. They are the start of the story. See you next time.